Awesome. Well, thanks for joining me for another edition of Venture School. Today, we're going to talk about what makes an attractive market size and why it matters to venture capitalists. And today, I'm going to explain why evaluating a market, understanding the market, why the market size, all of those things are crucial parts to a good venture capital investment. But stick around to the end because I'm going to twist it and tell you why some of the best investors don't invest in big markets. All right, so let's get started. So the first thing is market size. How big is the minimum market size you should be investing in? Well, in general, the rule of thumb is $1 billion. Now, as markets and the world economy changes and shifts, $1 billion is really like the bare minimum for a venture capital deal. And let's break down why. Let's talk about $1 billion market size minimum. So let's say that your company is targeting $1 billion market. $1 billion. Well, it's really hard to get market share, right, over time. But a successful company might get to 10% market share. If you could do that as a business, you would be a phenomenally successful business. Well, what does that mean? That means that your business is doing $100 million in revenue, right? 10% market share of $1 billion. Well, $100 million is enough to go public and create a successful outcome for your business. And usually companies that are doing about $100 million in revenue, especially for software, are going to be valued anywhere between 500 million to upwards of $3 billion, just kind of depending on the current market and the business and all of those other factors. So that gives you a pretty good return. That's only based on 10%. Now, it's really hard to go above 10% as a business, right? And so that's why you need at least $1 billion market size. Now, as a venture capitalist, why does this matter? Well, you have to understand how venture capital funds function. So let's say that I have a $100 million venture fund. That would be a little bit small for today, in today's world, but it's a good benchline for the math that we're going to do. So let's assume that I've got this $100 million fund, and I'm going to do 10 deals at $10 million each. And my goal for each one of these is to get 10% of the business by the time that it goes public or gets acquired. Now, typically what happens is a VC will go in and they'll invest, maybe they invest $5 million for 20% of the business, but then over time, the company raises more money and that 20% shrinks and shrinks, and they're putting in more money over time. And so eventually they get to about $10 million total deployed into the company, and they get diluted down to about 10%. And if you look at public filings of companies that have gone public and you look at the ownership by investors, it's not uncommon to see investors owning somewhere between 10 and 20% of the business, especially the Series A investors or the first institutional investors in the deal. So this is pretty realistic. This means that I'm going to do 10 deals at $10 million total deployed and own 10%. Now, if all of those companies were successful, right, up in here in this case, then that means that my returns on a successful company are going to range anywhere between $50 million, right, 10% of 500 million, to 300 million. Okay, well, that seems pretty good. Like if all 10 of my investments are successful, then I'm going to generate 50 million to 300 million. But here's the thing. These companies aren't all successful. In fact, venture capital is extremely risky and follows what we call the power law distribution. Now, you're probably familiar with distribution models that look like this. This is the normal distribution, right? Where in the middle, you've got the average. And then you've got outcomes out here, and you've got a few that are really good and a few out here where you lose all your money, right? But then most of them are kind of in this average. That's not how venture capital works. The reality is venture capital follows what we call a power law distribution that looks like this, wherein you have all these different outcomes, and the reality is that the best outcome is the most successful and generates most of the returns. And then the next one generates substantially less and substantially less and substantially less all the way out. And so as a venture capitalist, you may only have one deal out of these 10 that are really successful. In fact, you would be considered a phenomenal investor if you had just 1 in 10 that ended up generating $50 to $300 million of return for your fund. What does that mean? Well, if I have one deal that's successful of my 10 and it generates a $50 million return, I only returned half the money. On the other hand, if I can get it up to 300 million, then I will have returned 3 times my fund. Now, the typical venture fund is striving to get somewhere between 3 to 5x their fund, which means that if I have a $100 million fund, I end up returning back to my investors $300 to $500 million. And in order to do that, I have to then be backing these companies that operate in these large markets. Now, let's assume that the market doubles to 2 billion, right? And I'm able to get that same amount of market share, 10% market share. Then that means that my returns could be 100 million to 600 million, and makes the math work. Every single deal, all 10 of these, ultimately have to have that same opportunity of getting to this type of outcome where they're valued at either 500 million to 3 billion, or if the market's bigger, potentially getting $1 billion to $6 billion outcome. And the reason for that is because what you wouldn't want to do is make 10 investments, 9 of which are in smaller markets with smaller outcomes, and then you risk it all on the big one, and the big one fails, and the other ones, most of the other ones also fail, but you end up just returning a lot less money, because then you can't return your whole fund, and if you can't return your fund and you can't generate meaningful profits for your investors, they're not going to give you money for your next fund, which is why markets really, really matter, and why $1 billion really is kind of the minimum. Now, a lot of venture capitalists will look for even bigger returns. And the reason for that is fund size keeps going up and up and up. When I started working in venture capital, it wasn't uncommon for the typical venture fund to be about $100 million. Today, it's not uncommon for venture funds to be managing upwards of $1 billion. And in fact, some funds like Tiger Global manage tens of billions of dollars, which means they're not looking at markets that are $100 million. They're looking at markets that are $100 billion to $1 trillion. And you might think like $1 trillion is market size. Like, do those markets even exist? And they do. Examples of that would be like companies like Uber. Now, when I first looked at Uber years ago and heard about it as a deal, I was like, really? Like, small market, $11 billion taxi market, highly fragmented, highly regulated. Like, why are investors so excited about it? And what I didn't realize is that the real market opportunity for Uber wasn't the taxi market. It was the transportation market, which is $1 trillion plus market. And that's why Uber today is valued, somewhere around $100 billion timing in the market. All right. So hopefully I've convinced you that big markets matter, right? And there's some other reasons too why big markets matter, because markets that are really big, and growing, it's easier to grow with the market, for example. You don't have to steal market share, you're just acquiring new customers and bringing them along for the ride. If it's a really big market, there could be lots of different players, and there could be lots of different solutions that people are looking for, right? Like maybe I need just a slight tweak on the solution for it to work for me and my pain point. And so it's easier to set up a competing solution to do that and compete with other companies. I want to share this quote with you. So this is from Ben Horowitz, who is like one of the all-time best venture capitalists out there. And he said, we as in Andreessen Horowitz, his venture fund, we like to invest in college dropouts with insane ideas going after tiny markets with no way to monetize. That sounds like a winning investment strategy, right? But here's the thing. Think about like some of the best deals that Andreessen Horowitz has backed over the years. Companies like Airbnb. When Airbnb launched, the market for renting a room in your house like didn't even exist, right? Super tiny. The best thing that existed was a website called like Couchsurfing, and they didn't even charge for it. You could just go on and say, hey, I have a couch. If somebody who's traveling through wants to borrow it, they can, right? That was your market. And if you think about like what's interesting about Airbnb is a lot of people would say, okay, yeah, but just look at the parallel market. And the parallel market is the hotel industry, and that's a big market. And so really it was okay. But I would challenge that too. And the reason for that is because what Airbnb has done is they've established a brand new market. If you go back to when they first started, one of the challenges for people that wanted to travel was that it was really expensive to find hotel accommodations that were affordable, right? You travel to this other country, and then you'd be spending hundreds of dollars on a hotel. And that was your only way to get a roof over your head while you were traveling. It made it impossible for people to travel. What Airbnb did is by opening up all of these assets, right, that had been sitting dormant essentially, and making them available for people to rent, they drastically drove down the price of hotel costs for travelers. And today, as a traveler, if you want, you can go and you can travel and stay in different cities around the world for as little as like 25, 30 bucks a night. And if you pay even more, a couple $100s, you get like a whole apartment, multiple bedrooms, kitchen, like the equivalent of that is thousands of dollars suite at a hotel. So they drastically drove down the price. And what that did was create this huge market opportunity where more people could enter the market than ever before and drastically grow traveling. In fact, I'm a firm believer that part of the reason why millennials say that they prefer experiences over things is because for the first time ever, thanks to companies like Airbnb, they could afford to travel and see the world in ways that they weren't able to before. So anyways, punchline is look for big markets. Now, some of the times those markets already exist and they're big, right? Other times it's about the market opportunity and how big that could get. And really, if you understand your pain points of your customer and the value that's being created by the solution, it can give you directional insight into how big those market opportunities can be. Thanks for joining me today. If this was helpful, give me a thumbs up and join me for the next video on how our venture capital private equity fund's structured. Thank you.